It's time now for today's strategy session. Risk-off sentiment gripping today's trading action as stocks open in the red, but market momentum holding up some stocks, trading near record highs. Can the market continue its rally despite a growing wall of worry for investors? Joining us now, we've got Kenny Polcari, who is the Slatestone Wealth Chief Market Strategist. Kenny, one of the things that you and I were talking about in the break, and perhaps is within that wall of worry to a certain extent, is the retail sales print that came out this morning. What's your evaluation of that?
It appears, as you look at it right at the top, that it's weak, right? But if you really dig down into it, what you see is that it's auto sales and building material that really dragged it down. And look, you're not buying a car every day, and when people who haven't bought a car, when they go out and they see what the prices of cars are these days, then they take a second look and they think, well, maybe I'm going to keep the car I have for a little bit longer, because you know, $70,000 or $80,000 or $90,000 for a car with a $1,200 or $1,500 a month payment just doesn't work. So I don't think it's the consumer that's unable to do it. I just think the consumer is choosing not to do it, right? But if you look at online sales, those are up. You look at furniture, those sales were up. So I don't think it's as negative as the headline number tells you. I just think that consumers are becoming more discerning because some prices are out of control, so they're just choosing not to buy it.
You mentioned building materials too. Is there anything we should extrapolate from that part of the print as well?
No, I don't think so. I think that you have to. People are going to. When I think of building materials, I think of like going to Home Depot and do-it-yourself stuff and updating the home that you're in. I think people are just taking a step back because they're wondering if housing prices are going to come down a little bit more. Maybe it's going to be an opportunity for them to get out of one and into another, and so they might just be taking a step back. But I don't think this report makes me nervous at all, because I just think that it's those two top line numbers that to me don't suggest retail sales. When I think of retail sales, I think you're going into TJ Maxx or Bloomingdale's, you're buying a shirt, you're buying clothes, you're buying shoes, you're buying, right? Yeah. Autos, while it's a retail sale, it's a very big retail sale. And I think the numbers for automobiles today are just causing people to take a step back.
You've got Middle East conflict, you've got an FOMC meeting kicking off, and oh yeah, we're approaching, as we were mentioning a moment ago, that July 9th deadline. With all of these factors at play, and certainly being weighed on the mind of investors, where are you prioritizing each matter?
Right, so I think you have to play it cautious. I remain cautiously optimistic, but look, the Middle East stuff and the geopolitical stuff is going to continue to cause anxiety and unrest in the markets. But remember, geopolitical stuff doesn't price stocks in the long term. They actually create short-term chaos, which then provides an opportunity for a long-term investor, because some people get nervous. They just want their cash. They don't want to own stocks in that environment. They just want to know that they have their money. Okay, great. So they sell stocks, not because the thesis has changed on why you want to own Apple or Nvidia or Amazon, more because they're just afraid, right? And so when they dislocate the price of those stocks for a long-term investor that is not necessarily afraid, it's a buying opportunity for them. Now, if the thesis changes, that's a different story. But right now, the geopolitical stuff is not going to change the thesis for a range of stocks. In fact, it might even bolster the reason to go out and buy defense, aerospace and defense names, that kind of stuff, which are certainly catching a bid over the last couple of weeks.
One of the typical trades we see during times of conflict, and of course, not just sliding to the side, the humanitarian side as well, but of course, evaluating for our viewers watching exactly how this is impacting as well some of the thesis that's playing out in the market that we're seeing in response here.
And you got the Fed. You know, the meeting starts today.
Right.
You know, the announcement's tomorrow, 2:30. Then we're going to see the dot plot, which I always think is kind of interesting, because it is just what it says. Yeah. These guys on the committee, they sit there with a pencil and they draw a little circle on a piece of graph paper.
Is that simple? Ticonderoga number two?
That's like, I hate to say it, it's like elementary school, right? They draw. There's nothing technological about it. And then they suggest, you know, it suggests where these guys, men and women, think rates are going to be. I think rates. Look, you're not getting a cut tomorrow.
You think we get 50 basis points by the end of the year?
I don't. I'm still in the camp that he's not cutting rates. And I actually don't think he does. He should, because cutting rates is going to stimulate the economy, and the macro data continues, in my opinion, to be fairly robust. Unemployment's at 4.2%. That's closer to the lows than the highs by any stretch, right? And the other data, in my mind, continues to be strong enough. GDP is expected to be 3.8% in the second quarter.
Sure.
Right? That's a very strong number. So nothing there suggests to me that the economy's going off the edge.
It makes you wonder if we actually were in an economic emergency in order to trigger the tariffs.
100%.
That might be a different conversation. And people can listen in to many more of your conversations as well. Be sure to tune in to Trader Talk every Wednesday at 12 p.m. Eastern and scan the QR code below to stay up to date with all the latest episodes. Kenny, thank you.